Welcome to Corporate Finance. Welcome to Session 10 of Introduction to Corporate Finance on making capital investment decisions. Again, effective capital investment decisions, major capital investments, like this product that I'm holding in my hand. This is Cottonelle Fresh Roll Wipes, produced by Kleenex back in the day, circa 2001. And this was supposed to be the most positive MPV project in American history. It was touted on The Tonight Show with Jay Leno, of all places. It was touted in the Wall Street Journal as a new form of toilet paper. Everyone will want this. This will be just a gigantic hit. The company, Kleenex, had spent $100 million in research and development, $30 million on marketing and advertising. So hundreds of millions of dollars, 9 patents, I think it was, on this product. And it was an unmitigated disaster. Why? Because they made some errors in judgment, errors in forecasting. So here, Chapter 4 comes into play, where you have to have accurate forecast. So in this session, we're going to talk about forecasting those cash flows of any new product and how important it is to get it as accurate as you can. We want to focus on incremental cash flows, after-tax cash flows, and relevant cash flows. We're going to build 3 pro forma statements that we learned in Session 3, and that is the income statement, the balance sheet, and the statement of cash flows. Pro forma means for a matter of form. For me, if you're doing a pro forma, to me, it does not just mean a forecast. If you have 5 years of actuals and then provide me with 5 years of forecast, that's what I call a pro forma, for a matter of form. And they come in order: income statement first, balance sheet second, and statement of cash flows third. We'll look at some alternative investments, things that you can do with your money, alternative ideas, and then some special cases. How do you do the same analysis if you're installing a major chunk of highway, let's say, if you're a major road manufacturer like a Glen Hawbaker or an HRI locally? Do we do the same thing? Do we do an income statement, a balance sheet, and a statement of cash flows? These authors would suggest, yes, I want to do that. And then the follow-on from Chapter 9, the IRRs, the MPVs, and the payback periods. These are the types of analyses we do to make effective capital investment decisions. Some key formulas: cash flow from assets, CFFA. We learned this way back in Session 2. CFFA is OCF minus NCS minus CNWC. We talked about back then how to calculate these various components and where we get the numbers from. We mentioned also that CFFA is all frequently called free cash flow. So how do we calculate free cash flow in these big capital investment projects? To calculate the OCF, we can use the old traditional approach we learned in Chapter 2, all coming from the income statement, EBIT plus D minus T. But if there is no interest expense on your project's income statement, we can use 3 new approaches: bottom-up, top-down, and tax shield. Bottom-up approaches: net income plus depreciation, NPAT plus D, so very simple. Again, if there's no interest expense, we can use these 3 methods. Top-down approach: OCF is sales minus cost minus taxes. And finally, with no interest expense, we can use the tax shield approach: sales minus cost times 1 minus tax rate, plus quantity depreciation times tax rate. And again, those 3, only if and only if there's no interest expense on the income statement. Any other case, or the safest case to calculate OCF, is always the traditional approach that we learned in Session 2.